Okay, so the entire financial world is basically holding its breath right now. After a long, aggressive fight against inflation, the US Federal Reserve is getting ready to make a huge move. In this explainer, we're going to break down what's being called the Great Pivot, and more importantly, what it could mean for your wallet.
Now you might be thinking, hey, I don't live in the US, why should I care what their central bank is up to? And that's a fair question. But as we're about to see, the Fed's decisions create these massive ripple effects that can touch your investments in your bank account no matter where you are in the world.
All right, let's get right into it. Here's our game plan. First, we'll define this Great Pivot. Then, we'll dig into why it's happening. After that, we'll trace the ripple effects across the markets, lay out a possible playbook for investors, and finally, touch on what to keep an eye on moving forward.
So first up, what exactly is this Great Pivot that has the entire financial world on the edge of its seat? Let's unpack that.
Think of it like this. For the past couple of years, the Fed has been slamming on the economic brakes, hard, to slow things down and fight inflation. Now, it looks like they're ready to take their foot off the brake and maybe, just maybe, even tap the accelerator a little bit. That's the Great Pivot in a nutshell. So, that naturally leads to the next big question. Why the sudden change of heart? After all this effort raising rates, what's behind this major shift in strategy?
Well, the Fed has seen three big signs that it's time to change course. First, inflation. The very beast they've been trying to tame is finally starting to cool off. That's huge. Second, the job market, which has been absolutely on fire, is beginning to soften a bit. And third, they're worried. They don't want to keep their foot on the brake for so long that they accidentally steer the whole economy into a recession.
Okay, this is where things get really, really interesting. We're about to see how one single decision can send shockwaves through the entire global financial system, hitting everything from currencies to your own retirement account.
And the very first domino to fall, the most immediate impact, is going to be on the currency markets, specifically the value of the US dollar.
Just imagine your savings account is paying 5% interest. Pretty nice, right? Then, suddenly, your bank cuts it down to 2%. What are you going to do? You're probably going to start looking for a different bank with a better rate. Well, it's the exact same idea for the US dollar. When US interest rates fall, big global investors start shopping around for other countries where they can get a better return on their money.
And a weaker dollar can be a massive boost for emerging markets. For one thing, it makes their exports cheaper and way more competitive globally. Plus, it makes it easier for them to pay back their debts, since a lot of that debt is held in US dollars.
Okay, let's follow that ripple over to the bond market, because the effect here is super direct and honestly pretty powerful.
So this is one of those classic rules in finance. It's like a seesaw. When the central bank cuts interest rates, the price of existing bonds, the ones that are still paying that older, higher rate, they become much more attractive, so their price goes up.
And this expert opinion really confirms what the market is thinking. That whole period of rapidly rising bond yields? Yeah, that's probably over. So for investors who are looking for a bit more stability, bonds are suddenly looking like a much more compelling place to be.
And finally, that third ripple hits the stock market. And lower interest rates can be like rocket fuel for stocks, especially for all those tech companies and other businesses focused on growth.
There are really two main reasons for this. First, it's just cheaper for companies to borrow money. That means they can invest more in growing their business, which can lead to bigger profits. And second, for those huge growth companies like the Magnificent Seven, we're talking Apple, Microsoft, Amazon, lower rates make their potential future earnings look way more valuable today.
Okay, so we know how this pivot affects currencies, bonds, and stocks. So the big question for all of us is, how do you strategically position your portfolio to navigate this new landscape?
Well, the analysis seems to point to a pretty clear three-pronged strategy. First, focus on those growth sectors that really benefit from lower borrowing costs. Second, with a weaker dollar on the horizon, look for opportunities in emerging markets. And third, consider grabbing some quality bonds to lock in today's higher yields before they potentially drop even more.
All right, we have covered a lot of ground here. So let's do a quick wrap-up and just nail down the key takeaways from the Fed's Great Pivot.
So, to recap, the Fed is pivoting because inflation is finally getting under control, and they want to avoid a recession. This is likely to mean a weaker dollar, higher bond prices, and a pretty friendly environment for growth stocks. Bottom line, this is a moment for investors to be paying very close attention and thinking about their next move.
And that leaves us with the final big question, doesn't it? The market has already factored in a lot of this news, but
Will the Fed actually deliver what everyone's expecting? And could there still be some surprises along the way? That is what we'll all be watching in the months ahead.